Most people believe markets react to bad news. A bank fails, a headline breaks, confidence disappears. That explanation feels intuitive, and it's comforting because it suggests risk arrives loudly with warnings everyone can see. But in practice, markets rarely respond to what is obvious. They respond to what has been quietly changing long before it becomes visible. By the time a failure reaches the news, the conditions that caused it are usually no longer new. They've already been absorbed, priced, and managed, at least by those paying close attention. What actually moves markets is not the event itself, but the realization that something underneath the surface has shifted in a way most participants had not fully accounted for. This is why periods that appear calm on the outside often precede stress. Volatility does not announce itself in advance. Structural pressure builds silently through balance sheets, funding costs, and incentives, until a small event reveals a much larger change in the system. Markets don't fear bad news. They fear what most people haven't noticed yet. Understanding that distinction matters because it changes where you look for risk. Instead of focusing on headlines, you start paying attention to mechanics. Instead of reacting to outcomes, you examine conditions. That is the lens we need to use to understand what just happened and why it matters beyond a single institution or a single weekend. In mid-January 2026, federal banking regulators closed a community bank headquartered in Illinois following a supervisory review. At the time of closure, the institution reported approximately $261 million in total assets, placing it firmly in the category of a small regional or community bank. The Federal Deposit Insurance Corporation, FDIC, was appointed as receiver, which is the standard legal process when a federally insured bank is determined to be no longer viable. As part of the resolution, the FDIC executed a purchase and assumption (P&A) agreement with another U.S.-based bank. Under this arrangement, substantially all deposits were transferred to the acquiring institution. From the perspective of depositors, access to funds continued without interruption. Checking and savings accounts remained available, debit cards functioned normally, and branches reopened under the acquiring bank's name on the next business day. Deposits remained protected within the limits of federal insurance coverage. Equity holders and unsecured creditors were not protected under the resolution process. As is customary in FDIC receiverships, common equity was rendered worthless at the time of closure, and claims by unsecured creditors were subject to the receivership process. According to the FDIC's preliminary estimates, the resolution is expected to result in a cost of approximately $20 to $21 million to the Deposit Insurance Fund, DIF. The DIF is funded by assessments on insured banks, not by direct taxpayer appropriations. Regulatory filings cited unsafe and unsound banking practices and an impaired capital position as the primary reasons for the closure. These terms indicate that the bank no longer met minimum regulatory capital requirements necessary to operate safely. The institution's business model was primarily focused on commercial lending, including loans to small and mid-sized businesses within its regional footprint. No evidence of fraud or operational misconduct was disclosed at the time of the announcement. This closure marked the first bank failure reported in the U.S. banking system in 2026, following a period in the second half of 2025 during which no insured institutions were closed. This event matters not because of the size of the institution involved, but because of what it reveals about the current operating environment for smaller banks. At the first-order level, the immediate effects are contained. Depositors retained access to funds, payment systems continued functioning, and no broader market disruption followed. From a systemic stability perspective, the resolution process worked as designed. The second-order effects are where analytical significance begins. Community and regional banks operate with a structural disadvantage in a high-interest rate environment. Their asset base, primarily loans, reprices slowly, while their liabilities, deposits, reprice quickly. When policy rates remain elevated for an extended period, this mismatch compresses net interest margins. Over time, compressed margins reduce retained earnings, weaken capital buffers, and limit a bank's ability to absorb credit losses. The pressure intensifies when loan performance deteriorates simultaneously. Many smaller banks have concentrated exposure to commercial borrowers, particularly small and mid-sized businesses. These borrowers are typically more sensitive to higher financing costs, slowing demand and declining collateral values. As cash flow weakens, loan delinquencies rise and expected losses increase. Once capital falls below regulatory thresholds, supervisory intervention becomes unavoidable. At that point, resolution is not a reaction to panic, but a response to arithmetic. The process is mechanical rather than discretionary. Beyond the affected institution, there are broader implications for credit availability. When a community bank is resolved, its lending activity effectively stops. Even when assets are acquired by another institution, underwriting standards often tighten during the transition. This creates localized credit friction, particularly for businesses that rely on relationship-based banking rather than standardized credit models. There is also a signaling effect within the banking sector. Each resolution increases scrutiny on peer institutions with similar balance sheet characteristics. Analysts, regulators, and investors begin reassessing exposure to the same risk factors: funding costs, capital adequacy, and loan concentration. This can accelerate conservative behavior across the sector, including reduced lending and higher liquidity buffers. Importantly, none of these dynamics require a deterioration in headline economic data. They unfold even in environments where employment remains strong and consumer spending is stable. The stress emerges from rate persistence, not rate shocks. From a market perspective, this distinction matters. Events like this do not necessarily trigger immediate repricing across asset classes, but they contribute to a gradual shift in expectations, particularly around credit growth, regional bank profitability, and merger activity. In that sense, the significance of this closure lies less in its immediate impact and more in its role as a data point. It reflects how prolonged monetary tightening works its way through the financial system unevenly, affecting institutions with less balance sheet flexibility first. Understanding this cause and effect chain helps frame the event not as an isolated failure, but as part of a broader adjustment process already underway. Periods of stress among smaller banks are not new, but context matters. The most common comparison is the 2008 to 2009 financial crisis. In that period, bank failures were driven primarily by credit quality collapse tied to residential housing, excessive leverage, and complex securitization. Capital erosion happened rapidly, liquidity froze, and multiple large institutions failed or required extraordinary intervention. The current environment differs in important ways. First, bank capital levels entering this cycle were meaningfully higher. Post-2008 regulatory reforms increased minimum capital and liquidity requirements, particularly for systemically important institutions. As a result, stress today is more likely to surface at the margins, among smaller banks with concentrated exposures, rather than at the core of the system. Second, the source of pressure is different. In earlier cycles, losses were triggered by a sharp economic contraction. In the current cycle, stress is emerging primarily from prolonged high interest rates rather than a sudden collapse in growth. The mechanism is slower and more uneven. Institutions are not failing because assets disappeared overnight, but because funding costs rose faster than asset income adjusted. A more relevant historical parallel may be the late 1980s and early 1990s, during the savings and loan crisis. In that episode, many institutions failed not due to immediate panic, but due to structural mismatches between assets and liabilities in a higher rate environment. Loss recognition occurred gradually, often following regulatory reviews rather than market runs. However, even that comparison has limits. Today's banking system operates in a digital environment with faster information flow and more mobile deposits. At the same time, resolution tools are more established, and regulators have greater experience managing closures without disrupting depositors. What history helps clarify is not what will happen next, but how stress tends to unfold. It usually appears first in institutions with narrow business models, high concentration in a single asset class, limited access to external capital. History also shows that consolidation often follows these periods. Stronger institutions acquire weaker ones, reducing the overall number of banks while increasing average size. What is different this time is the combination of persistent rate pressure and sector-specific exposure, particularly in commercial real estate. That combination has not yet fully worked through balance sheets, which is why isolated failures can occur even when broader economic indicators remain stable. Using history in this way helps reduce emotional bias. It frames current events as part of an adjustment process rather than a singular shock, while still acknowledging that the environment presents challenges that did not exist in exactly the same form in past cycles. This section is not about prediction. It is about conditional outcomes based on how current variables evolve. Each scenario relies on publicly discussed frameworks and forecasts from recognized institutions. None represent a confirmed path. Bull case, conditions improve gradually. If inflation continues to trend lower over the next several quarters and policy rates are reduced modestly in response, funding pressure on smaller banks would ease. According to Federal Reserve projections, summary of economic projections, a gradual decline in inflation could allow for lower policy rates over time. This is a forecast, not a commitment. In this scenario, deposit competition would soften, net interest margins would stabilize, and banks would gain time to work through stressed assets. Under these conditions, loan losses remain manageable. Commercial borrowers refinance without widespread defaults. Bank capital erosion slows rather than accelerates. Consolidation would still occur, but primarily through negotiated mergers rather than regulatory closures. Credit availability would stabilize, particularly for established small businesses with strong cash flow. This scenario requires macroeconomic resilience and policy flexibility without a renewed inflation surge. It represents a more constructive adjustment rather than a disorderly one. Base case, extended adjustment period. The base case reflects the outlook described by several institutions, including the IMF and Federal Reserve, which anticipates slower growth and sustained financial tightening without a severe recession. This is an outlook, not a certainty. In this scenario, interest rates remain elevated for longer than historical norms. Inflation moderates but does not fall quickly. Credit conditions tighten incrementally. Banks with diversified loan books and strong liquidity remain viable, while those with concentrated exposure, particularly to commercial real estate, face ongoing stress. Some institutions exit through acquisitions or FDIC-assisted resolutions, but failures remain episodic rather than systemic. Credit availability becomes more selective. Lending shifts toward higher quality borrowers, and underwriting standards remain conservative. Economic activity slows, particularly in interest-sensitive sectors, but does not collapse. This scenario implies continued pressure without panic, where adjustment occurs through time rather than shock. Bear case, stress intensifies. The bear case depends on a change in key assumptions. If inflation reaccelerates or remains stubbornly high and policy rates remain elevated longer than expected, refinancing risk increases materially. Forecasts from rating agencies such as Moody's and S&P have highlighted this risk, noting elevated default potential in certain commercial real estate segments. These are forward-looking assessments, not confirmed outcomes. In this environment, loan losses rise faster than capital buffers. Deposit competition intensifies. Investor confidence in smaller banks deteriorates. Resolution activity would likely increase, particularly among institutions with limited capital access. Credit contraction would become more pronounced, affecting small and mid-sized businesses first. This scenario does not require a broad economic collapse. It requires only rate persistence combined with asset value pressure. The resulting feedback loop, tighter credit, weaker growth, higher defaults, would reinforce stress across the sector. Why scenarios matter? Professional risk management does not rely on a single forecast. It evaluates how systems behave under different conditions and prepares accordingly. The purpose of scenario analysis is not to choose a narrative, but to identify which variables matter most. Inflation persistence, rate policy, credit performance, capital resilience. Those variables, not headlines, determine outcomes over time. Rather than focusing on individual bank failures, I pay closer attention to a small set of indicators that reflect system-wide conditions. These signals tend to change before stress becomes visible in headlines. One of the most important is the US dollar index, DXY. A strengthening dollar often coincides with tighter financial conditions. When the dollar rises, global funding becomes more expensive, and risk appetite typically declines. Sustained dollar strength can place additional pressure on institutions that rely on wholesale funding or foreign capital flows. U.S. Treasury yields, particularly at the short and intermediate maturities, are another key input. Elevated yields increase funding costs across the banking system and influence deposit behavior. The shape of the yield curve also matters. An inverted or flat curve compresses bank margins, while a steepening curve can signal either improving growth expectations or rising inflation risk, depending on the context. Inflation data, including CPI and PCE, remains central. These measures guide expectations for monetary policy. Markets respond not just to the level of inflation, but to its direction and persistence. A slower than expected decline in inflation can delay policy adjustments, extending pressure on rate-sensitive sectors. Within credit markets, I monitor commercial real estate delinquency rates and refinancing volumes. Rising delinquencies or reduced refinancing activity indicates stress in a segment that is closely linked to smaller banks. These data points often move gradually, making them more useful as trend indicators than as short-term signals. Liquidity and positioning metrics also provide insight. Trading volume, open interest, and fund flows help reveal whether capital is moving defensively or seeking risk. Persistent outflows from regional bank equities or credit instruments can signal deteriorating confidence even in the absence of major news. Finally, I pay attention to bank earnings reports and regulatory disclosures, particularly changes in loan loss provisions and capital ratios. These adjustments often reflect management's internal assessment of future risk rather than current conditions. Taken together, these indicators offer a framework for understanding stress before it becomes visible. None of them provide certainty on their own, but in combination, they help clarify whether conditions are stabilizing, tightening, or shifting in a way that warrants closer attention. Events like this tend to attract strong reactions, but they are best understood without urgency or fear. A single bank resolution does not define the direction of the economy, nor does it guarantee broader instability. What it does provide is information, a data point within a larger adjustment process shaped by interest rates, credit conditions, and balance sheet resilience. Periods of transition often feel uncomfortable because outcomes are less predictable than in times of expansion. That is not the same as disorder. Financial systems adjust through cycles of tightening and easing, consolidation and expansion. The current environment reflects that adjustment rather than a sudden breakdown. From an analytical standpoint, the priority is not forecasting headlines, but managing uncertainty. That means focusing on risk management, diversification, and patience rather than reacting to short-term developments. This isn't investment advice. It's simply how I'm reading the market right now, by separating signal from noise and structure from emotion. Over time, clarity tends to emerge not from prediction, but from disciplined observation.